Well, some strong company earnings reporting has pushed US markets higher again, but our own market has really struggled to maintain the gains. Hi there everyone, welcome to the Traders Circle Weekly Market Update. Today is Tuesday, the 6th of February 2024, and before I get into the session, you do need to be aware that whatever I say is general advice only, so it does not consider your personal financial circumstances, and you have to decide whether it's appropriate for you. Alright, so let's talk about central banks. We've been talking about them for over 24 months now. In fact, we've been talking about them forever, but their importance has only increased over the past couple of years. And that's because we are in the middle of an inflation battle. Some thought the battle was over. In fact, late last year, markets were rallying because they believed that we were out of the battle was over, we'd won the battle, and that inflation was no longer a problem. But since then, data has continued to come in fairly inflationary, and we saw the Fed meet at the end of January, and they did say, don't expect rate cuts too soon, don't expect too many rate cuts this year, because the data is still very strong. US CPI growth was strong at the January reading. Other economic data continues to come in strong, and in fact on Friday we saw US unemployment come in way lower than expected, US wages, hourly earnings way stronger than expected, way more jobs created than expected, and that doesn't point to the economic slowdown that really would be necessary to slow inflation. So inflation, I think, the market declared the battle won, but I don't think the battle is over just yet. The central banks don't want to, start cutting rates, don't want to ease up on the brake pedal until it is clear that we've dealt with inflation, because the worst case scenario would be if things re-inflate. We don't want to have to start to, see inflation spike again and have to start to go to more rate rises again. So instead, we're probably going to see rates remain fairly strong for a while yet. Now, we also had the RBA meeting today, the February meeting. From this point onwards, they're going to be every 6 weeks. And the RBA also said that, even though inflation has come down from its peaks last year, it's still a big problem. And they did say that further tightening, further rate rises may be necessary. Now, obviously, they're just trying to spook the market there. But for a market that's become convinced that we're going to see tons of rate cuts beginning very shortly, it really sort of says to them that they've gotten way too far ahead of themselves. The market has definitely sort of, I think, become way too aggressive in forecasting rapid near-term rate cuts. Now, I'll just caveat that by saying that the Fed and the RBA have not been very good predictors of future rates ever. No point in history have they been able to tell you what rates would be in a year's time. And so, we don't really know whether they're going to keep rates high or whether they're going to cut them, or what the rates are going to look like in a year's time. But I do think that the market has not really been paying the data the proper attention when it comes to how inflationary is it actually slowing, and is inflation coming down. And so all the gains that we saw from the stock market in November and December, based around March rate cuts, 7 US rate cuts this year, I think look way overdone. Now, the US gains have been helped a little bit further by some pretty strong earnings reporting from a handful of large tech stocks. But overall, they do start to look a bit questionable when you consider that a March rate cut is now quite unlikely, and when you consider that we're very unlikely to see, even 5 rate cuts this year from the Fed. All right, so let's touch on earnings. Obviously, the US earnings season is well underway. On Friday, we saw really strong, on Thursday night, we saw really strong earnings reports from Facebook, Meta, and from Amazon. In fact, Facebook was up 20%. After they declared their maiden dividend, their first ever dividend. Amazon was up 8%. And there's been definitely a few very large stocks that have declared really strong earnings. But if you remove those very large stocks, if you look at, say, outside the top sort of 20 stocks, outside the top 30 stocks, if you look at the remaining 470 of the S&P 500, the earnings haven't been particularly good, and in fact they've been consistently revised lower into this earnings period. And then outside of the top ones, the earnings on average have been pretty poor. And it does sort of go to show just how important the very large stocks are for the US market at the moment. In many ways, the US market had some really negative news in the form of that jobs report on Friday, and the fact that they were able to close higher on Friday purely comes down to just the strength of Facebook's report, the strength of Amazon's report, and the effect that had on similar large technology stocks. Overall, I do think that this US earnings season suggests that US markets are quite overdone outside of again the very large caps, and even then those very large caps are extremely expensive. So US markets are looking a bit expensive, but at least in the US markets, their earnings growth isn't too bad because it's being propped up by a handful of large companies. When looking at our own market, earnings growth for FY24 looks dismal. I think the consensus is for about a bit over a 2% fall in market earnings for 2024 from the Australian market. Macquarie's analysts actually have it around 7% fall in FY24 earnings for the Australian market. A lot of that is the banks and miners sort of reducing their earnings, but even so, earnings growth for our market is not looking good for this financial year. Now, when you consider that our market is at an all-time high, well above its average levels for last year, and earnings are expected to fall, possibly between 2 and 7%, I do think there's a lot of risk with our coming earnings season. So our earnings season is going to really start in earnest next week. There's a few smallies sort of trickling in over the next few days, but the majority of large stocks start reporting from next week onwards. If their earnings are as bad as expected, it's going to make our current market levels not seem particularly attractive, particularly when you consider how high these miners are, how high these banks are relative to earnings that are expected to fall. So like I said, they could surprise to the upside, but as the earnings are expected, it does present a bit of risk with the coming earnings season. So like always in any earnings season, if you are considering any trade or investment, make sure you go to Google, make sure you go to the trading calendar and you type in, that stock and then investor calendar. And, make sure you're not going to hold it over an earnings report, or if you are, consider the effect the earnings report might have on your trade. And like I said, I do think we're going to see a lot of movement in the current earnings season. I think there's going to be some fairly large movements, given that I think shares in many cases have disconnected from what earnings are likely to be. So let's have a quick look at the charts. This is the US S&P 500, and we can see that it actually reached a fresh all-time high on Friday, and that was after the Facebook report, after the Amazon report, and they topped out, at least they closed around sort of 49.60 roughly. They did come down a little bit overnight. That was with comments from Jerome Powell on Monday on 60 Minutes, where he said they, markets had got ahead of themselves with the rate cut narrative. But even with that, and even with Friday's strong jobs report, they really haven't been able to sort of put any strong selling together. And in many ways, the momentum still looks firmly to the upside for US markets. In terms of where they might stop out, it's very, very hard to say, but markets do love round numbers. People put in their sell orders at round numbers, and so we might see, the S&P 500 reach 5,000 index points. It's barely 1% away from the market at the moment. Realistically, though, I do think that they're going to run out of steam somewhere around the current levels. I already think they're quite a bit overdone, and I already think that the narrative that a lot of this rally has been built on has really been challenged across the past fortnight. Looking at our own market, and we don't look quite as positive. We've topped out around 7,700 late last week. We've come down on Monday. We've come down in today's session. And overall, I do think there's a fair chance that we reach the uptrend line in the coming sessions. That would put us around maybe 7,500, maybe just above it, maybe just below it, depending on timing. And I do think, that we're going to have to wait to see that line be tested to see if we hold it. If we do hold it, we could return to 7,700, but if we break through, we might go back to January's low around 7,350, which would be the next key level. Now, it does look a far way away, and it does look like all the momentum is up, but like I said, the narrative that this rally has been built on has really started to be challenged across the past fortnight. There will be some key tests for the market in the coming weeks, particularly here in Australia, the earnings season. So we'll have to see what next week looks like next Tuesday. Hope you guys enjoyed. If you did, click like, click subscribe, and we'll see you in the next one.